exposing the secrets behind successful businesses, starts with a simple click. Welcome to Business Diaries. Alright, let's talk about something super important. We are talking about interest rates. You hear this term all the time, don't you? But what does it really mean for you and your money? Simply put, an interest rate is the cost of borrowing money. Think of it like this. If you need to borrow money, you have to pay a fee for using it. That fee is the interest. It is usually a percentage of the amount you borrow. This percentage might seem small, but believe me, it can add up to a whole lot of money over time, so you must understand it. You absolutely must. Now, why should you care about interest rates? Oh, you should care a great deal. Interest rates are not just numbers for bankers or economists to worry about. No, they affect almost every single financial decision you make in your life. They impact how much you pay for your home. They impact how much you pay for your car. They even impact how fast your savings can grow. Understanding interest rates gives you power. It gives you control over your financial future. And that is what we all want, isn't it? Financial security and peace of mind. When you take out a loan, the interest rate is a very big deal indeed. Whether it is a mortgage for your dream home, a loan for a new car, or even the balance on your credit card. A higher interest rate means you will pay back much more than you originally borrowed, much more. This is how banks make money. But it can also be how debt can spiral out of control if you are not careful. So before you sign on any dotted line for any loan, you must look at that interest rate. You must understand what it means for your monthly payments and the total cost. But interest rates are not just about borrowing. They also work for you when you save money. Yes, that's right. When you put your money into a savings account or a certificate of deposit, a CD, the bank pays you interest. They are paying you for letting them use your money. So in this case, a higher interest rate is fantastic news for you. It means your savings will grow faster. Your money is working for you, earning more money. This is how you build wealth, slowly, steadily, but surely. It is a beautiful thing to see your savings compound and grow, thanks to interest. Okay, so you know what interest rates are. Now let's get into the different types you will see. One of the most important distinctions is between fixed and variable interest rates. A fixed interest rate means just that. It is fixed. It stays the same for the entire term of your loan or your investment. So if you have a fixed rate mortgage, your interest payment will not change for 15 years or 30 years or however long the loan is. This provides predictability. You know exactly what to expect each month. This can make budgeting so much easier. There are no surprises with a fixed rate. Then you have variable interest rates, and variable means, you guessed it, it can change. It can go up, it can go down. These rates are often tied to some underlying benchmark interest rate, like the prime rate. So, if that benchmark rate changes, your interest rate changes too. This means your monthly loan payments could increase if rates go up, or the interest you earn on savings could decrease if rates fall. Variable rates can sometimes start lower than fixed rates, but they come with more uncertainty. You have to be prepared for those potential changes in your payments. You will encounter different types of interest rates for different financial products. For example, mortgage rates are what you pay on a home loan. These can be fixed or variable. Credit card interest rates, often called the annual percentage rate or APR, are usually variable and can be very high. Very high. This is why credit card debt can be so dangerous. Savings account rates tell you how much you will earn on your deposits. Car loan rates are for financing a vehicle. Student loan rates help pay for education. Each of these will have specific terms and conditions, so always read the fine print. Always. Now, how do banks decide what interest rates to offer you on loans or savings? Well, banks are businesses. They are there to make a profit, of course. One major factor is the cost of funds for the bank itself, which is influenced by the central bank's rates. Another huge factor is you. Yes, you. They look at your creditworthiness. Your credit score is a big part of this. A good credit score tells them you are a lower risk, so you will likely get a better, lower interest rate. If your credit is not so good, you are seen as higher risk, and you will pay a higher interest rate. It is that simple. So who has the biggest influence on interest rates overall? That would be the central bank. In the United States, our central bank is the Federal Reserve, often just called the Fed. Most countries have a similar institution. Think of the central bank as the bank for other banks. It also manages the nation's money supply and tries to keep our economy stable and healthy. This is a massive responsibility. It's not just about printing money, it's about guiding the entire financial system. Their decisions can have far-reaching effects on everyone. The main way a central bank, like the Fed, influences interest rates is by setting a key short-term interest rate. In the US, this is called the federal funds rate. This is the rate at which commercial banks lend money to each other overnight. When the central bank raises or lowers this key rate, it sends a signal. And other interest rates in the economy usually follow suit. It creates a ripple effect. So, when you hear on the news that the Fed raised rates, you can expect that borrowing costs for mortgages, credit cards, and car loans might soon go up too. Why do central banks bother changing these interest rates? They do it to manage the economy. It's all about balance. If the economy is growing too fast and inflation is becoming a problem, meaning prices are rising too quickly, the central bank might raise interest rates. This makes borrowing more expensive. The idea is that people and businesses will borrow and spend less. This can help to cool down the economy and control inflation. It's like tapping the brakes on a car that's going too fast. This is a critical tool for them. Conversely, if the economy is sluggish or in a recession, and people are not spending enough, the central bank might lower interest rates. This makes borrowing cheaper. The hope is that this will encourage people and businesses to borrow more money, spend more money, and invest more. This can help to stimulate economic growth and create jobs. So, the central bank is constantly trying to find that sweet spot. Not too much growth, not too little. Their decisions are complex and they affect every single one of us whether we realize it or not. Alright, let's bring this all home. How do these interest rates, set by banks and influenced by the Fed, actually impact your wallet every single day? Oh, they do, believe me. Think about your mortgage. If you have a variable rate mortgage and interest rates go up, your monthly payment could increase significantly. That means less money for other things. Or think about your credit card. If you carry a balance, a high interest rate means that debt can grow and grow, making it harder to pay off. It's not just an abstract number, it's real money out of your pocket. Interest rates also play a huge role when you are making big purchases. Are you thinking about buying a new home? The interest rate on your mortgage will determine how much house you can truly afford, and it will massively impact the total amount you pay over the life of the loan. Same thing for buying a car. A lower interest rate can save you hundreds, even thousands of dollars. So it's not just about the price of the item, it's about the total cost of borrowing the money to buy that item. You must always factor that in. And what about your savings and investments? When interest rates on savings accounts are high, your money grows more easily. That is great. But when interest rates are very, very low, like they have been at times, your savings might not even keep up with inflation. That means your money is actually losing its purchasing power over time. This is why you cannot just let your money sit there without a plan. You need to understand how current interest rates affect your different savings and investment options. You need to make your money work for you. So, to wrap this all up, interest rates are fundamentally the cost of borrowing money or the reward you get for saving it. They can be fixed, meaning they stay the same, or variable, meaning they can change. Banks set the rates they offer you based on their costs and your risk, while central banks, like the Federal Reserve, influence overall rate levels to manage the economy. Most importantly, these rates have a direct and significant impact on your loans, your savings, and your overall financial health. Please, 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 take the time to understand interest rates. Knowledge is power, especially when it comes to your money. You are approved to take control.